Hello and welcome to Apex Capital. So today in this video we will be taking a look at Waaree Energies Limited. It is the largest pure play integrated solar module and cell manufacturer in India. Now what does that mean? Solar module is the component which converts the energy of sun into electrical energy. Now each solar module is composed of multiple solar cells, also known as photovoltaic cells. Although Waaree Energy is one of the largest players in the module manufacturing in the solar module manufacturing space, there are multiple companies in this space as of now. Now, most of these companies actually import the photovoltaic cell or the solar cell from Chinese manufacturers and assemble them into solar modules to sell to Indian customers. There are barely 2 to 3 companies, including Waaree Energies, which are now also manufacturing their own solar cells for their solar module assembly. Interestingly, Waaree Energy's stock has seen significant correction over the past 3 months. Now, this is not really limited to just our company. In fact, this has been a sector-wide correction in the solar energy space. So, Waaree Energies used to trade at around 36 to 3700 price point per share in September of last year. Even in October, it was at 3600 per share. After that, it has seen a significant correction, which has been continuing all until now, and now it's trading at around 25 to 2600 rupees per share. So that's a significant correction of about 27 to 28% in barely 3 months. And as I said, this is not specific to our company. This is a correction which you will find in most companies operating in solar module manufacturing space. A big reason why such correction has happened is, of course, profit booking, since a lot of investors which entered the solar sector companies at the start of 2025 made immense returns by the late 2025, right? So at some point this profit booking had to happen, and I'm glad it has happened sooner than later, because now it has created another good opportunity to enter the stock if we have the conviction. Another big reason why this correction has sustained for so long is that there are two major headwinds in the solar energy space. The first one being that the solar energy is now a commoditized business, right? So the companies no longer have pricing power for their solar modules, right? So what this causes is that large pre-established players like Waaree Energies, Premier Energies, Vikram Solar, these companies lose their pricing power and thus lose their operating margins, which they have maintained for past a few quarters. Another headwind being, of course, the demand supply mismatch, where there have been concerns that the demand for solar energy is not really growing that much as compared to the capacity for manufacturing which these companies have installed, right? For example, if we take a look at Waaree Energies, then they have a present capacity of almost 16.1 plus 2.6, that is 18.7 gigawatt of installed capacity for module manufacturing, and they are planning to increase it to 26.7 gigawatt by the end of financial year 2026. So that's a lot of module manufacturing capacity, although the actual utilization for this capacity is very low. For the last quarter, it was barely 2.6 gigawatt. Now, even if you multiply this number by 4, take the latest quarter results and multiply it by 4, you get a module production of barely 10 to 11 gigawatts on an yearly basis. Although their yearly capacity is almost now 18.7 gigawatt already. So that's a capacity utilization of only 54%. And if you find such figures for most companies in this space, you will notice that capacity utilization in module manufacturing companies stand at barely 50 to 60%, right? What this means is that their order book doesn't really reflect the kind of demand they were expecting. They have built a whole lot of capacity to manufacture these solar modules, but if there is no demand, then all this capex is of no use. So that is another headwind which I believe is the reason the initial sell-off has continued for so long, right? So in this video we will be focusing on Waaree Energies Limited. We will also compare our company to its competitors in the module manufacturing space, and see what the future holds for this space in general and for Waaree Energies. Alright, so now let's take a look at the pricing ratios and profitability ratios of our company. So Waaree Energy currently trades at a price to earning ratio of 27, a price to sales ratio of 4, and a price to book value of around 6.5. Now PE ratio and PS ratio are alright, but the price to book value does look a bit on the higher side, and although this high ratio can be justified if you take a look at their sales growth for the past 3 years, which has been almost 70% CAGR. So this 70% sales growth is a very explosive growth, and companies in having such explosive growth are justified having a high price to book or even high price to earning ratios. Also, taking a look at their earnings growth, it has been 191% over the past 3 years. So the PEG ratio, also known as the price to earnings growth ratio, which is given by PE ratio divided by profit growth for the past 3 years, comes at about 0.14. A PEG ratio lower than 1 is considered good for the company, and Waaree Energies has an extremely low PEG ratio of only 0.14. Now all these valuation metrics do look good. The reason for that being that the company is showing immense growth year on year. Now, as we already discussed, that there are certain headwinds in this whole solar energy space. So once this explosive growth drops out, the company will start to look expensive, although for the time being this is not the case. And the PEG ratio being 0.14 tells me that the company is a very, very lucrative investment opportunity. Taking a look at their profitability ratios, the return on capital is at 35% and return on equity is 27%. Again, phenomenal numbers. So normally people take the cost of capital to be around 10 to 12%. Now for a 10 to 12% cost of capital, if you are generating a return of 35% on capital employed, that's a very, very huge return, right? Also, their EV to EBITDA ratio stands at around 15 again, which is comparable to their peers. In fact, relatively lower than other players in the solar energy space, right? So if you take a look at their peers and take a look at the EV to EBIT numbers, Waaree Energies does have a lower ratio compared to most of their peers, right? In terms of profitability ratios and the ratios like PE, PS, etc., the company does look like a lucrative investment opportunity, although you have to keep in mind the whole scenario where the growth drops out and the margins fall off, because the current operating margin is too good. 22.6 EBITDA margin is, any EBITDA margin above 20% is actually remarkable. So for Waaree Energies it is currently 22.6%. Dividend yield is also low, and it's understandable because in such a high growth phase most companies tend to reinvest their earnings into the business itself for more acquisitions and capital expenditures in order to expand their business. So it's understandable that their dividend yield is on the lower side. Taking a look at their median PE ratio, right? So as we talked out in the start of the video itself, that for most of the last year the company was richly valued and traded at a median price to earning of 40, right? But now, since after the correction, they are trading at a price to earning ratio of around 27. All right, then company is expected to give a good quarter. Yeah, so if you take a look at the earnings estimate for the next quarter, then you will. Okay, so yeah, so the next earnings reporting date is January 29, 2026, and that will be for Q3 FY26 earnings. And the EPS estimates are 37.75, and the revenue estimate for the next quarter is around 64.5 billion, or you can say 6,500 crores. Approximately, right? So if we take a look at the last quarter, they report in September and Q2 FY26, they reported sales of 60 billion or 6,000 crores and earning per share of almost 29.29. So if the next quarter is really as good as the estimates are, then that would be a big bullish indicator for the company, right? And we might see a sudden uptick in the stock price. So the EPS estimate of 37.75 and a revenue estimate of almost 6.5 thousand crores for the next quarter. Alright, so now let's take a look at the peers and compare Waaree Energies with its competitors in the same industry. So for that I have prepared this a small summary of all the Indian companies in the solar energy space. So as you can see, there are multiple companies, among which Waaree Energies, Premier Energies, and MV Photovoltaic Power Limited are the three companies with the largest order book, and these are the only three companies with integrated cell as well as module manufacturing. Right, so they are not only creating the modules but also manufacturing the solar cells in India itself. The smaller companies like Alpex Solar, Solex Energy, Websol, Vikram Solar, etc., they are module manufacturers, but for that they import the solar cells from Chinese manufacturers and then assemble them in India into solar modules, right? Now, many of these smaller companies are also planning to enter the cell manufacturing space by financial year 2027, and they've already committed capex for that. So some of these companies are also planning to enter other spaces like EPC and IPP space, right? So they are allied industries in solar energy. Then so among these three companies, Waaree Energies has the largest standing order book, and also it's peculiar because all these companies derive their revenue almost entirely from India. 90 to 95% of their revenue comes from domestic sales, while Waaree Energies is the only company which has a significant export revenue as well. So 50% of their revenue comes from North American markets, particularly USA and Canada, and rest 50% of the revenue comes from domestic sales, that is from India. Now, this export business gives them an obvious advantage that it improves their margins, but it also carries a significant geopolitical risk. For example, Waaree Energies does have to face the brunt of the tariffs imposed by USA on Indian manufacturers. So, to counter that, they have established a cell manufacturing plant in Texas, USA, so as to bypass the tariffs imposed by the USA. Now, these three companies, Waaree Energies, Premier Energies, and MV, have certain minute differences in their business models. So, for example, MV Photovoltaic is the only company with 100% of their cell manufacturing based on the TOPCon technology. So, if you go into specifics, basically the solar cells can be made using multiple technologies. The monopark technology was the older technology, and TOPCon technology is the latest one and the more efficient one. So, MV Photovoltaic has 100% of their cell manufacturing based on the TOPCon technology, TOPCon type of cells, right? Premier Energies and Waaree Energies also have mostly TOPCon cells, but they do have some share of monopark solar cells as well. Similarly, if we take a look into Premier Energies, then compared to other companies, they have a better capacity utilization, and also they are expanding into BESS sector. But overall, Waaree Energy seems to be the best bet because of their best downstream integration, as they are also entering into ingots and wafer manufacturing beginning from FY27. So, for example, if we take a look into their earnings presentation, so yeah, this is the entire value chain right from polysilicon, which is the raw material, to the solar module, which is the end product. So in between there are ingots, wafers, and then solar cells, and finally solar modules. So we have module manufacturers, we have integrated cell as well as module manufacturers, but Waaree Energies is planning to go a step even further into ingots and wafer manufacturing. Once they enter into that, they will capture the entire value chain. So that will be, so their entire product will be made indigenously right from the raw material. They are also diversifying into other businesses and doing capex in order in other businesses like BESS, hydrogen storage, green hydrogen storage, inverters, power infrastructure, and they have already committed significant capex into all these ventures. So once again, if we go to their this in the earnings presentation, so this slide shows their diversified investments quite well. BESS, or the battery energy storage system, this is the most significant uh, investment I feel. So they have already committed a capex of up to 10,000 crores for BESS system development, which will be based on lithium ion storage cell technology, and they plan to have a plant capacity of 20 gigawatt hour, of which phase 1, which will be operational by FY27, will have 3.5 gigawatt hour, and the work for which is already on track and under construction. Then they are also planning to enter into inverters manufacturing. Then green hydrogen is also one of the energy storage technology, and for that they are entering into electrolyzer manufacturing, and then they are also entering into power infrastructure. So as we already discussed, that solar energy space itself won't won't be able to sustain the revenues for these companies 3 to 4 years down into the future. So it's good that solar energy companies are investing into BESS and all these other revenue streams. Let's take a look at the financials of the company now. So these were the quarterly results. Yeah, so YOY sales growth of 70% in the last quarter. Then EBITDA margin for the last quarter was about 23%, and it has stayed consistently at this 23% for quite some time. Mm, Then P&L statement, as we can see that sales growth is significant. For on a 5-year basis, CAGR sales growth is 49%. For 3 years, it is 72%. Then on their balance sheet, again, it looks healthy. Now, if we take a look here, the enterprise value for Waaree Energies stands at about 68,870 crore, approximately 69,000 crores, while their market cap is about 73,700 crores. So their enterprise value is even lower than the market cap. Why? Because they have more cash on their balance sheet. As you can see, cash equivalent is about 7,700 crores. and they have more cash on their balance sheet compared to the total debt, which is stands at about 3000 crores. So since the cash is more than debt, that's why their enterprise value is lower than the market cap of the company. So I have gone through these financial statements in detail in my DCF discounted cash flow valuation model, and which I will show you later in this video. So yeah, shareholding pattern. The shareholding pattern is a very important thing which you should track for any company in which you are planning to invest or are already invested in. So if you look on a yearly basis, then the FIIs have bought significant quantity of this stock. Their holding has gone from 0.7% in March last year to 6.91% by December of last year, right? DII holding has also increased from 2.46% to 2.86%. So the pattern is basically that the institutions are buying from the retail shareholders. So that's a very bullish sign for any company. And if we dissect it further on a quarterly basis, then even after September 2025 high, after which the sell-off began, the FII holding has only gone up from 6.35% to 6.91%. Similarly, DII holding has also gone up, although very less, 2.82 to 2.86%, yet it has gone up. This means that even the brutal sell-off in the last 2 to 3 months is not really driven by institutional selling. It's mostly just a retail panic selling or profit booking, we can say. So that is sort of driving this sell-off. So this again is a very bullish sign for the future of the company. Alright, so let's take a look at the discounted cash flow based valuation model of Waaree Energies. So I basically use three estimates in order to forecast the future cash flows of the company. The first one being the revenue growth rate, which is the growth lever of the company. Then the operating margin, which is the profitability lever of the company. Note that the operating margin here is the EBIT margin, not the EBITDA margin, right? So EBIT means earnings before interest and taxes. Then finally, the third estimate being the sales to invested capital ratio, which tells us about the efficiency of the growth lever, right? So sales to invested capital ratio basically means the total revenue of the company divided by the invested capital. Now invested capital here is given by the total equity plus debt minus the cash. For example, if the sales to invested capital ratio of a company is 3, what this means is that for every $1 of invested capital into the company will generate $3 in revenue. So that will help you understand this ratio better, right? So for revenue estimates, although the company has shown explosive growth in the past 5 years of about 50% CAGR and a 70% CAGR in past 3 years, I have taken relatively modest growth estimates at 25% CAGR for the next 5 years. FY26 growth is a big number of 55%. It's purely because of the management guidance that they will be doing EBITDA of about 5500 to 66,000 crores in the financial year 26, right? So based on their current margins, to do a EBITDA of 6,000 crores, they should be doing a revenue of somewhere around 20 to 25,000 crores. And later on, this is what the revenue estimates look like. Now, in terms of operating margins, the company has current EBITDA margins of around 23%, and the management is guiding that they're optimistic that their EBITDA margins will improve going into the future. So assuming their EBITDA margin stabilizes at around 24 to 25%, it's fair to assume that their EBIT margins will stand at about 20% for the next 5 years. And thereafter, I've assumed that it would taper down to around 15%. For sales to invested capital ratio, again, I have chosen this number arbitrarily based on their capex guidance for the next few years, as well as based on the overall sales to invested capital ratio among the industry peers. So these are what the estimates look like. Based on that, you can calculate the share value. So I have calculated a weighted average cost of capital to be around 9.2%. Based on this discount rate, I get a share value of around 3,500 per share. If I use a flat discount rate of 10%, then I get a share value of around 3,300 per share. If you use a higher discount rate of about 12%, then you get a share value of around 2,800 per share. For terminal value, you can either use the Gordon growth model, which is typically used in most DCF valuations, or you can also use the exit multiple. So I have used a 10x EV to EBITDA ratio as the exit multiple, and based on that, I have gotten this as the terminal value. So that's basically the point of DCF. It gives you a whole range of values based on your own estimates and based on what discount rate you are willing to apply to the future cash flows, right? So That completes our discussion for Waaree Energies. This video is not a buy or sell recommendation, it's just my own analysis, and you have to take your own decision based on your own conviction. Now, I do feel that Waaree Energies is a good bet to make, especially if you are bullish on this whole renewable solar energy sector. Mainly because of two reasons. The first one, of course, being the excellent downstream integration they are planning to do, right? They are not only limited to module manufacturing, they have already started solar cell manufacturing, and they also plan to expand into ingots and wafers very soon, right? So that's an excellent downstream integration, and I do feel that it will prove to be a crucial advantage for Waaree Energies in future. The second reason being that Waaree Energies has invested quite a lot of money and in order to diversify their revenue streams for future. Especially this battery energy storage system, the BESS, might prove to be a big theme in the coming 5-year period, right? So Waaree Energies is quite well placed in order to take advantage of that opportunity, right? So this completes our discussion. If you find this video helpful, then do drop a like and subscribe to our channel. Thanks for watching and see you in the next one.